All right, good morning, everybody. Welcome to our January 12th, 2011 FXDD co-production with FXStreet.com webinar. We're going to be teaching some good stuff for you today. Now, our disclaimer is we do not give buy, sell, or hold. Recommendation trading is risky. You want to make sure you trade only with risk capital that will not affect your lifestyle. Okay, so this is going to be a great class for everybody. It's called Greg's New Year's Resolutions for 2011. I think you're going to enjoy this one. Now, here I am on the left-hand side. I'm Sean Powell, National Training Director at FXDD. I'm along for the ride to help Greg out. Greg Michalowski is our Vice President and Chief Currency and Trading Analyst at the company. Many of you know him from his trainings on FXStreet.com or his speaking engagements around the world. Ed was talking earlier about Greg's new book. That's going to be coming out shortly as well. If you would like more details on Greg, you can actually go right into FX Street. He is someone who posts on a regular basis at FXStreet.com. It's blogs.fxstreet.com/fxtrader-link for all the details on Greg. And we do these twice a month with FX Street. They're so much fun, and you're going to learn a lot. Now, FXDD.com/FXStreet will get you in on our special bonus that we have going on right now. This is an interesting promotion, and the promotion is Demo Dollars. Trade in a demo account. When you make profits in that demo account, you can transfer some of those to a live account. This is exciting. You can get all the details at FXDD.com/FXStreet.
All right, thanks, Sean. I really appreciate it. And I'm putting on my screen here. I hope you can see my cover page. If you can't, just let me know here, and then I'll get started. Okay, Harley gives me a thumbs up, so we're okay. As Sean mentioned, I'm going to be talking about my Forex trading New Year's resolutions. It's that time of the year for New Year's resolutions. Before I get started, I want to bring up one of my friend's Facebook page where he listed his New Year's resolutions. Well, he called them goals for 2011, and they started off on page 1 here with spiritual, family, service. It goes to page 2, whereas professional, political, physical, and personal. I thought rest would be 1. I have 1 to lose weight once again for 2011. I hope to be as thin as Sean Powell in that picture when we started off at some point this year. But Jeff sure has a lot going for him here as far as his resolutions go. And to get some comments from some of his friends were that's all you got, and I just want to make it through the week. And I think that sums up what I try to do as well, in addition to losing a few pounds. To give you an idea, this is my friend Jeff. One of his resolutions is to cross this bridge on his hands, and I think judging from the look of his arms there, I think he probably did it. So anyway, I thought I'd start off with a little fun here to get the ball rolling, to start thinking about New Year's resolutions. And I have not 20 or 30 like Jeff had. I have just my top 10 trading New Year's resolutions that I thought I would share with you all. That I would, and hopefully through my resolutions, through my experience in the foreign exchange market, through my understanding of what I want to do right and what I want to not do wrong, allows you to help you in your trading for the year as well. So with that said, let's pop the champagne corks and get going with my top 10 resolutions. And the first 2 I'm going to put up together are kind of linked. And the first one is always have a, in parenthetical, technical reason to enter a trade, technical as opposed to a fundamental reason to enter a trade, and always define risk. I put these 2 together. Why? Because in my mind, and why I love technical analysis, especially in foreign exchange trading, is this: that technical analysis gives you tools that allow you to not only define a bias to the market, is the market bullish, is the market bearish, but it also allows you to define your risk just by definition. If you have a technical tool that tells you that the market is turning from bearish to bullish, you have by definition also are able to define your risk. So if the market moves from bearish to bullish because it does something from a technical perspective, and I'll get to that in just a second, but I just want to put it in words here first. So it goes from bearish to bullish. Guess what happens if the market turns around and goes from bullish to bearish? on that technical tool. You're out. You're out. The market didn't do what it should do, what you thought it should do. And the one thing that I firmly believe is that you listen to what the market has to say, not to what you think, but listen to what the market has to say, and that's what technicals allow you to do. So with that said, I'm going to I'm going to move this over here. I'm going to take a look at some charts and show you exactly what I mean here. And I'm going to start off by looking at the euro versus the U.S. dollar here, and this is on an hourly basis, and this is the chart from today. This is today's trading range. This is yesterday's trading range, and this is the previous day. Each of these days are represented by these dashed lines here. But what I mean, there we go. So what I mean by using a technical reason to do a trade is I will use different technical tools in my analysis. And I'm going to zoom in here because it looks or it's closer, or it's easier to see. But one of the technical tools that I use is this blue line right here, and this represents a 100-hour moving average. We're looking at the hourly chart. It's a 100-hour moving average. It's just simple. It's on the close, no shift whatsoever. It's just a simple 100-hour moving average. This is what it's what I use. Why? Because I think the market follows this 100-hour moving average very closely. But from a technical perspective, what I mean by having a reason to do a trade is when the market approaches or trades around this 100-hour moving average, it tends to use it as a support or resistance level. It does so because the market follows this moving average. In my mind, I see it all the time. I rely on it. It helps me to define my risk at the same time. So, for instance, yesterday when the market was moving to the upside here, and we had this double top, here, or actually in the early trading here today, the market initially went up to that 100-hour moving average and then sold off a little bit, sold off back to support area at this 62 to 68 level, which is another key level. I'll get to that in a second. But and then the market based off that level and broke through the 100-hour moving average. And when it broke through on the second attempt to the top side here, the market really took off. And so that's a technical reason to buy the market. Why? Because the market went from below the moving average, which, by the way, it was below the moving average from this point right here going back to January 5th, to above the moving average. That's a significant move on an hourly chart to have that happen. And so we saw the reactionary move to the top side. Of course, what did we do? We ran into resistance up here. That's another reason to trade, and another reason why the market found profit takers on the move to the upside was why? Because the market could define the risk up here against these highs from January 7th. We respected these highs. This became a ceiling on that day. So the market moves from breaking above to the next target level. And when the market couldn't get above that level, what do? We fall. And where do we fall to? We fall to the 100-hour moving average. So the market is going back and forth to between these support and resistance levels, and those are the reasons to do trades. Trades done at these what I call borderline levels are important because they define your risk, and your risk is very limited. If the market should break below this 100-hour moving average, your risk may be just a small amount, maybe down to this low right here, down at the 68 level. This level came in at 80. So we're talking about 12 pips, 12, 13 pips, or 14 or 15 pips of risk on the trade, with the expectations that if the market holds this level, it has a potential to move higher. So my resolutions were to use these trading tools, use the technical tools that I use, and make sure I always have a risk and are always able to define the trade. Now, some of you may say, well, what about here, Greg, where you were buying against a 100-hour moving average here, and the market moved down to this 62-ish level on the downside? What would have happened there? Well, you know what? I may have gotten stopped out. I may have stopped myself out by buying at 71 and selling at 61. losing 10 pips because I was expecting the market to go down. But when the market was not able to continue the momentum to the downside, in the next hourly bar, we started moving higher and we closed above this 100-bar moving average. Look what the market did. It used that level, that 100-hour moving average, as a springboard to the top side. And this was a trade. So sometimes, sometimes, folks, what you have to do is be a little bit more patient. You know, it's always the hardest right at the beginning of the trade, but if you suck it in and you're able to withstand these little type corrections, you're able to, you know, perhaps have great trade location when the market really starts to move and we start to move, and it moves away from your entry level. That's my 1 and 2 New Year's resolutions for 2011. I'm going to take the charts off again, and I'm going to bring up my PowerPoint once again to get the other 7 down pat. So we know 1 and 2. Now we're going to look at 3, and 3 is the opposite of the technical reasons to enter trades. And what I promised to do in 2011 in regard to fundamentals analysis is to use fundamental analysis only as a secondary trading tool. Only as a secondary trading tool. And note I put a little parenthetical in there because I know a lot of you people out there probably fall for the old television commentaries when people get on TV and actually probably make a good case as far as which way the currency or the dollar should go up or down. But I'm gonna hold myself to the fact that if the technicals have to be my primary tool and the fundamentals are secondary, and if the technicals say something that if the market should have a directional bias to the upside, like we saw on the euro versus US dollar chart, where the market bounced off that 100-hour moving average on a number of different times, even if I'm fundamentally bearish in the euro. Why? Because you know, as Ed pointed out, there's all sorts of issues with the what I will point out is that even with the fundamental backdrop of the debt auctions that that are happening in the eurozone, the bias was for a technically bullish here today. The market was above the 100-hour moving average. It remained above the 100-hour moving average. It broke, and that was a bullish indicator for me. It was the first time it broke above the 100-hour moving average for January 5th. So I want to be able to follow that as opposed to following the fundamentals that may pop into my mind because of so-and-so said something on TV or that I have this bias from a fundamental perspective. The one thing I'd like to tell traders is that the technicals will always print the stories in tomorrow's paper. If the euro should go higher today, they're going to write the story of how the auction went well, how this happened or that happened, and the dollar as a result got sold off and the euro benefited from it. And you can rest assured that that's what the story is going to be. That's what the fundamental story is that they're going to write about. For me, what I would write if I was writing the paper was that the market moved above the 100-hour moving average, case closed, that's it. You know, that's the only reason why. If you want me to put a fundamental story on it, okay, I'll say that the auction went well, better than expected, even though initially the euro sold off after the auction results. Nevertheless, they found support against the 100-hour moving average, and the market moved higher. It's as simple as that, folks. So I promise that in 2011, I'm going to use fundamental analysis as my secondary tool. I'm going to use technical analysis as my primary tool. Now, some of you may be saying, should I get rid of fundamental analysis altogether? And my answer to that question is no. You still need to understand about fundamental analysis. You need to understand the risks in the market from a fundamental perspective, and that's one of the primary reasons why I use fundamental analysis, is because it does add a level of risk. If you know that economic data is coming out that's going to be a market moving, you want to know that. That's fundamental analysis. If you know a central banker has or the ECB has an interest rate decision coming up. And Jean-Claude Trichet is going to speak on Thursday after the meeting at 8:30 in New York time. You need to know that fundamental analysis, and you need to be aware of it. If you're aware, you're prepared, and you're able to diffuse some of the risk as a result of it. So that's number 3, use fundamental analysis as a secondary tool. Number 4, trade with the trend, especially if the market is trending. It sounds obvious that we all know that in order to make money, you need to trade the trend, and why? Because trends are directional, trends are fast. But what I see in the retail sector, time and time again, is a lot of people trading against the trend. They trade against the uptrend. Why? Because the market's higher, so they want to sell it. So they learn to sell high and buy low. Well, in a trending market, it goes even higher, and it goes even higher, and it goes even higher. So what you have to do is be able to trade with the trend, especially if the market is trending. But I do put a caveat, and that's number 5, because obviously the market doesn't go up in a straight line all the time. So what I will do, and what I will look for in the market is those opportunities when there's really good technical reason why the market should pause at a certain level, why the market should find some sellers in an uptrend or buyers in a downtrend. And if I can find that key technical reason where I could define my risk very clearly and able to map out a counter trend roadmap, that is, if I'm selling against a resistance level, I want to be able to make sure that I can understand where this market is going to the downside, where the key target levels are that the market is going to have to get through in order for me to keep that counter trend going. If I understand that, and I'm just a little bit more concerned about the direction of the counter trend than I am in the uptrend, but if I can do that, then I will do okay. But I promise that in 2011, if my trading a counter trend for a good technical reason that defines my risk, if the market doesn't do what it should do, that is, if the market does not go down, if I'm selling against the major trend to the upside, I am going to get out of that trade. I promise. If I'm wrong, I cover right away. So let's go to a chart, and I'll show you what I mean in regard to that. Take off that. Put my chart back on. Make sure I'm going to follow these sequences here. And one of the things, obviously, is this trend in the euro versus U.S. dollar is to the upside here for that currency pair. And what we can see here in the chart, which may make me think that I have an opportunity to sell, is that the market came up to the high for the day and it found sellers against that level, and the market reversed back. So we had a bar where the market hit a top and came back down to the downside. I may look at something like gold. Gold here, here's our moving average. Here's our 100-bar moving average. Here's our 200-bar moving average. The trend in this case is, if we were to look at this hourly chart just over the shorter term, is to the upside here. The market moved above the 100-hour moving average, came down. Notice how the market bounced off that 100-hour moving average. And if I were on top of this market, looking at gold, looking to trade gold, I might look to buy here against this 100-hour moving average. Why? Because risk is defined, and I have a technical reason to buy, right? Against the 100-hour moving average, risk is defined to maybe a few bucks or a buck or so, a couple bucks below the price here. That's all I have to risk is that much. And look what the potential gain was. The market moved straight up, moved up, and guess what? The market came right up to this 200-hour moving average and did the same thing. It found sellers against that level. Why? Because those people who are trading against this shorter-term trend here, maybe this intraday trend, this move to the upside here, would have had a reason to sell. They had the 200-hour moving average. In addition to that, they had the 50% retracement of this move down from this high to this low. That wasn't far behind the 200-day. I think came in at 1380.87, and the 50% retracement came in at 1388.20. So you had limited risk by selling against the trend here that we've seen over the last 4 days in the gold price. So that became a nice counter trend type move. And look where the market's going, heading back down toward a 100-bar moving average. A nice opportunity to trade against what is the it's a minor trend, but it's not necessarily a huge trend, and needless to say, it's probably a corrective trend. The fact that we went up to the 50% retracement of this move may suggest that the next move for the gold is through the 100-hour moving average to the downside. But I hope you get my point in regard to trading trends and trading counter trends. Is that there are let me just add this, is that there are trends from a longer-term perspective. There's also intermediate-term trends that you want to be able to pay attention, especially in these volatile currency pairs. So take that off. I'm going to put my PowerPoint back on. Make sure that I have the right the screen back on, so I don't do that mistake again. There we go. And so that's number 5. Is if I'm going to trade against what is the intermediate or the shorter term or longer term trend, I want to make sure that I have a strong reason that where I can define my risk, where I could also look for areas where the market may go that will allow me to keep track of what I'm doing and how I can trade against the trend without getting hurt. And if I end up finding out that the market doesn't do what it should do, I'm always out. I'm out quicker than I would perhaps even in a trend type move. My sixth resolution for 2011 is this: if a key economic release or event is coming out and I don't have a position, with a key economic event coming out, I will not take a new position. I will wait until the event risk is gone. And the point of this, folks, is that in my past, and perhaps in your past as well, we always get enamored with events, certain events like non-farm payroll, for instance, which came out last Friday. It was an intense event. People were waiting for it. People were anticipating the event. We had the ADP come out at 297,000 jobs, well above the 100,000 expectations. Estimates for non-farm payroll went up to 450,000 from some market analysts out there, economists with PhDs who know a lot more about the expectations for an economic number than I do, than any of you do. So you start to believe these people, and you start to make these judgments that, oh, by golly, this is going to really take off to the upside, and so I want to be long going into the non-farm payroll. Now, what non-farm payroll last Friday as an example, and this is the same for other key events, especially when the market gets really geared up for them, is that in the case on Friday was that the risk went up even more. The risk does not stay the same at all times. There's event risk for non-farm payroll that's normal. That is where you don't have this wide range of expectations or estimates for non-farm payroll. I mean, the estimates went from about 100,000 jobs to 450,000 jobs. That's a huge disparity. What does that do to your risk? That increases your risk. What should traders take on extra risk if they can, if they willingly can? No. What you as a trader have to try to do is make the most amount of money with the least amount of risk. And if you can do that, you're in a better position to stay in the game, to not blow up, to make sure that you're a winner. And I don't want to make that mistake of being suckered in to doing a trade right before a key economic release when risks are increased. I'd rather wait until the event risk is gone. When the event risk is gone, you can analyze the market in a clearer way. Think about the employment number on Friday. If I were to say that the non-farm payrolls would be closer to 100,000 than 200,000, you would have thought the dollar yen would get clobbered. It didn't. The dollar yen held in there. It went down eventually, or initially, it went down, but it rebounded pretty good, and then it kind of stabilized. And as we saw, or as you know, today in the market, the dollar yen is back higher. So it doesn't necessarily, even having tomorrow's newspaper in the foreign exchange market doesn't guarantee you anything. There's a lot of things that go on in the foreign exchange market that you and I cannot see. And if we can if we can take out event risk when event risk is elevated, and if I could do that, I'm going to be better able to trade the market with a clearer head, without the event risk, and to get back to my good old technicals that are going to show me the way and show me the market risk that I trade every day. And that's what you as a trader should do, is if you can, eliminate the event risk, instead focus on the market risk, and if you do that, I think you'll find yourself that your account does much better throughout the year, and mine will too. Number 7, if I wanted to do a trade, and I did not do the trade, and I have the market go in the direction of the trade I wanted to do, how many of you people have done that? Oh, I meant to buy the euro when it broke, when it held that 100-bar moving average. Now it's moving higher. I could still get in. It's probably going to go through that the high for the day. I'm just going to get in right here. Don't do that, okay? Wait until you have another opportunity where you can define your risk more clearly. Don't be one of those bandwagon traders who buy the momentum because you missed the initial trade. Wait, I've done this time and time again, and I promise in 2011 I'm going to try to stop myself from this horrible, horrible addiction. It's to jump on the bandwagon because I missed the trade. Folks, the one thing I can guarantee you, the only thing I can guarantee you is this: there will be another trade. There will be a better trade where you can define your risk. You'll always, always, always have an opportunity in the foreign exchange market, because most of the time the market may trend, but it'll come down. It'll test that moving average. It'll give you another opportunity where you can define your risk, where you can define your risk to a small amount and limit your risk and allow you to make that big profit, that multiple of the risk that you're taking on the trade. And that is what I'm going to try to do in 2011. I'm not going to chase the market, get on the bandwagon without defining my risk, having my risk too great. I'm going to make sure my risk is defined. It's small. I'm comfortable with it. I don't have the fear as a result of it, and I'm not going to put the trade on and fear right away. Fear without understanding what my risk is. That is no, and it actually it violates rule number 2, defining risk. So don't do the bandwagon trades. If you miss a trade, or don't do a trade because you just couldn't pull the trigger, there's a reason for that. You weren't ready to pull the trigger. You weren't comfortable with it. Realize that. Train your mind to say, I didn't do it because of a reason. I wasn't comfortable. Yes, I'm wrong, but that's okay. I'm going to be wrong a lot of times in trade and foreign exchange. No one is perfect, but I will guarantee you, and you have to realize that there will always be another trade in the foreign exchange market, so wait for it. Number 8, don't blow up. Don't blow up. Too many traders will have have consistent earnings, do all the right things, and then get caught in that one trade where they blow up. I see it time and time again at FXDD. There is always, if you go back in time and look at customers who have poor positions, maybe a customer will call up and say to me, oh, well, the RSI is overbought. Well, it's overbought. No, why? Because the market's trending, and the RSI can stay overbought for a long period of time. It doesn't define your risk like a moving average does, like a trend line does. An RSI is an oscillator that tells you overbought or oversold, but it doesn't tell you if the market's going to get even more overbought or more oversold. And those are the trades that cause people to blow up. Those trades where they don't define the risk, they go against their plan, and they blow up the trade. So what I try to tell people, and what I will do in 2011, is this. Follow what I call the if-should rule. And the if-should rule says this: if the market does A, B, C, it should do X, Y, Z. If it doesn't, get out. If the market does ABC, it should do XYZ. If it doesn't, get out. So what does that mean? ABC, XYZ. I don't understand what that means. It's probably what you're thinking now. And I'm going to put my chart back up again and put it up on there. If in this case, what it says is that if the market moves back above the 100-hour moving average right here in the euro versus US dollar, we can go to a different chart here, I guess. Here's one right here, the sterling versus US dollar. We broke above the trend line here when the market corrected down today. We came down to what I always like to keep the trend line in there because I always find that the market tends to bounce off of it again. But if I was buying against this borderline here, I would say if the market comes down and tests the trend line, that's the ABC, and goes through the trend, or if it tests the trend line, then the market should bounce off that trend line and move higher. If it doesn't, I want to get out. I have to get out. So in this case, if the market comes down, test this trend line, this key borderline level, and if it breaks, and I define my risk, you have to give yourself a little bit of buffer here, folks. You have to give yourself 15 or 20 pips, probably 20 pips in the sterling at least, or not at least, but around that. Make sure that that's less than 3% of your account value. If you do that and you define your risk and you're accepting of that risk and you feel comfortable with that trade, you're risking this amount with the potential that if the market doesn't do what it should do, then I'm going to get out. If it does, it should go higher. If it does what it should do, so again, if the market tests the trend line, the market should go higher. If it doesn't, then get out. So in this case, the market tested the trend line. It should go higher. It did what it did, and I didn't get to the point where I had to get out of the trade. And so that's my if-should rule, and that's what I think. That's what I'm going to follow in 2011. Is always follow the if-should rule. And if I do that, then I'm not going to blow up. And if you don't blow up, you have a much better chance to catch the waves to the upside in your trading, and that'll allow you to make the most amount of money with the least amount of risk in your trading. So don't blow up. Follow the if-should rule. And the other thing is, don't tell the market what to do. Instead, listen to what the market is telling you. Once again, don't let your ego get in the way, thinking that you can tell the market that it should go higher. Instead, listen to what the market technicals are telling you. And if the technicals say, we just broke this trend line, Greg, get out, then get out. If the technicals say, hey, this trend line held, stay in. See what happens. Use your stop below that trend line. Manage your profit if the market should go higher. And if you're able to do that, you'll be better suited to trade the market. So do we see is the camera? There we go. It's camera. There we go. Camera's back on my top 10. So that's number 8. Don't blow up. Follow the if-should rule. Number 9. Oops, I did both of them, but that's okay. Number 9 is have a technical reason to exit a trade. If you look at number 1, what was it? Have a technical reason to enter a trade. The same goes true for exiting trades, folks. There is no reason to just exit a trade because it went higher and you have a profit. I know there's that old Wall Street axiom that says bulls and bears make money and pigs get slaughtered and no one went broke taking a profit. I know. Those are sucker plays for you to get out of a trade without a reason. You always have to have a reason to exit a trade. Why? Because who knows how far it's going to go. And if you get out just because you have a profit, how do you know the market isn't going to trend another 200 pips to the upside? You don't. But if you have a reason, a technical reason to exit a trade, you can make a judgment as far as, okay, well, this is a key resistance level right here. If I sell against this level, I have the potential that the market could go back down and we could correct a little bit, and that'll allow me an opportunity to maybe even go long again at a lower price. But if you don't have that reason, well, the other thing is if you sell against a certain level, let's say you take a profit on a long position in the euro against the high from earlier in the day, guess what? If the market should break above that high, you should get back into your trade. You should get back long in the trade. But if you have a reason to exit the trade, like the high from earlier the day, is a reason to exit the trade. You have a reason to get back in the trade if the market should continue in the trend direction. And that's where you make the most amount of money, folks, is trading with the trend, following the trend. So, but don't just sell the market or get out of a position, sell or buy the market. Get out of position without a real reason for the exit. You should always make sure that you have a sound technical reason to exit a trade, and you could use tools like moving averages, Fibonacci retracements, or trend lines. Those are the three tools that I use in order to exit a trade, and we're going to go through a little of those a little later on when we analyze some of the markets, and I'll show you exactly what I mean as far as exiting the trade with a reason. The 10th reason, or 10th New Year's resolution that I'm going to have for 2011 is this: understand that my mission this year, and the mission for all Forex trading, is to make the most amount of money with the least amount of risk. To make the most amount of money with the least amount of risk. Do you follow that mission? You should all businesses, whether you're a restaurant owner, a retail owner, an accountant, or whatever, all businesses want to make the most amount of money, and that's the same for traders. But they also want to do it with risk, but with the least amount of risk. You don't want the most amount of risk. That old, more risk, more return, more risk, more losses, folks, is what I find in currency trading. The more risk, if you take the most risk that you have out there, chances are you're going to have the biggest loss in your trade because you took the most risk. That's just Sod's law. It's typically what happens. That's what causes you to do number 8, to blow up the account, because you want to take the most amount of risk. What smart traders do, what traders who survive in this game will do, and what I'm going to try to do in 2011 is understand that I want to make the most amount of money. Yes, I want to take a risk. Yes, but I want to keep my risk to the least amount that I'm most comfortable with, that will allow me to make the most amount of money. Will I make more than the guy who swings it around and gets LUCKY all year long? Probably not. That guy is probably going to blow up in subsequent years. We've seen it in Wall Street all the time. Think back to the mortgage crisis. All those bank traders who made a lot of money trading mortgage-backed securities and booked huge profits in their accounts got killed in a matter of 6 to 12 months in the mortgage crisis. They lost more than they ever made over their career in 6 to 12 months. It happens all the time. What you, as a independent foreign exchange currency trader, for a retail trader, however you want to describe yourself, you cannot do that. Okay, you cannot make those bets those huge bets and think that you're going to get away with it forever. So what you have to do is define your risk, keep your risk to the minimum, the least amount that you possibly can, and but at the same time try to make money playing smart by trading against key technical levels. If you do that, you're going to be more successful. And the way that you trade and you make the most amount of money with the least amount of risk is this, folks, is what I call my game plan, and that is to trade trends and keep your fear to a minimum. Trade trends. Trends are where the most money is made. Trends are fast. Trends are directional. Trends will allow you to take a position and make the most amount of money with the least amount of risk. If you're right, if you bought the market against that 100-bar moving average here today in the euro and it trended up on the 5-minute chart in a nice fashion, you made the most amount of money with the least amount of risk. Your risk was 10 or 15 pips. You had the opportunity to make 80 or so pips to the upside. That's pretty good, a risk-reward relationship, isn't it? Of course it is. That's what you have to try to do in 2011, is to trade the trends. And by the way, if you define your risk, that is, if you use the least amount of risk the way that I've showed you so far in some of the examples that we've done today, that's going to also have the added benefit of keeping that 4-letter word that we all try to ignore, fear, out of the equation. Fear is a trader's worst enemy, folks. If trading the trends is the angel, is the good, fear is your enemy. Fear is the devil. You want to avoid fear as best as you can. And the way that you avoid fear is by doing number 2. Always define your risk. By using technicals, number 1. You always want to do that. You want to trade with the trends. You want to keep fundamentals out of it. Use it as a secondary tool. You want to do all these things, 1 through 9, and that will allow you to keep your fear to a minimum. And if you can keep your fear to a minimum, you have a much better chance of staying in the game, not blowing up, having your account value grow in 2011 rather than come off in 2011. So I see the time is 10:45. I got about 10 or so minutes. If anyone has any questions, you can type them into the system. Otherwise, if anyone has any currencies that you perhaps want me to take a look at, I can take a look at them from my technical perspective, and I can show you a little bit more, what I mean from these top 10 things by looking at some of the charts. So the floor is yours, folks. Put in a currency. If you don't want to put in one, I'll take one myself. So. All right, euro, sterling versus U.S. dollar, 2 good ones. All right, let's look at those currency pairs. Euro Swiss. All right, let me. There we go. Do you see? Hold on a second. Let me just take it off here, and then I'm gonna put it back on. I'm gonna put it back on the chart. All right, so you want to take a look at the euro. We've looked a lot at the euro. But what I want to show you as far as the key technical level here in the euro, which we just went up to a high of 56. What we're seeing here, folks, in the euro versus U.S. dollar really quickly is a interesting dynamic. Over the last 3 days, the range for the euro has been less than 100 pips for each of the trading days. Today's high is 56. The low today was 61. So we still have less than 100 pips in the euro. Yesterday we had less than 100 in the euro. The day before we had less than 100 pips in the euro. But the market keeps on inching up to the upside, so that keeps the bullish bias here intact. But it could be more corrective here because we're not seeing the momentum to the upside. What is going to be key for the euro, folks, a key technical level, a key level that perhaps the market may be looking at is this level right here off the daily chart. I look at the daily, we looked at the hourly chart for most of the session here today. But if you go to the daily chart, there's another key level, a key borderline level that we're moving toward here, moving toward in this 3-day correction after this move to the downside. And that, I think, is going to determine the bullish or bearish bias here for the euro in the shorter term. And that is this green line is a 200-day moving average that comes in at 130.70. We can see that the 50% retracement of this move from this low in June to the high came in at 130.78. So 130.70 to 78 is a key resistance level here for the euro versus U.S. dollar. I would expect that today, that if we see any further move to the upside, we got to a high of 56 here today, that there's a low risk trading opportunity to sell against the 70 to 78 level. Your risk is if the price should move above those levels, and then the other level we're going to be watching is really 87. So I would be a patient. I'm constructive on the market, but it has to break through that 78 level on the top side in order for me to, and stay above that level in order for me to continue with the bullish bias here in the euro. So I do expect to see some sellers against that low risk trading opportunity in the euro versus U.S. dollar. Let me go to sterling versus yen. That currency pair is at a key level as well here. Again, on the daily chart, the 100-day moving average comes in at the 130.50 level here today. 130.50. You can see there as I put the cursor over that chart. I'm going to zoom in here and take a look at that a little bit closer here. So, come on, you can do it. You can do it, Greg. The market is above that 130.50 level, currently trading at 130.59. We need to see some momentum to the upside here. We may, though, however, find some resistance. Why? Because the market since January 1 has been into a nice little move to the upside. We had a move to the upside correction, another move to test the 100-day moving average. It wasn't in early December or mid-December. We went above the 100-bar moving average. We went above the 100-bar moving average here. But most of the activity has been below the 100-day moving average. So that's two. That could say two things. One, that the market has finally bottomed and we have some room to the upside. And if you look at the 38.2% retracement of this move to the downside that really started going back to August of 2009, there's a lot of room to go in the sterling versus U.S. dollar here to the upside. But we have to show that this 50 level here on a closing basis here today is going to hold. So the market is going to have to make up its mind tick when you have this, first a nice move to the upside and moving average. You get some sort of resistance. I go back to this point right here. Nice move to the upside, get to the 100, and come on a corrective move, and then move off of that direction. So I'm a little bit, I'm going to be watching this level very closely here, expecting to see a little bit of selling in the sterling versus yen, and then look for a better opportunity to buy on the dip. Euro Swiss, that's one I haven't really looked at that much of late, but I know the Swiss franc is moving higher. Let's see here. Euro Swiss still remains, toward the bottom end of the trading range here. I had an old trend line in here. I'm probably going to take this one out here. I haven't looked at this currency pair. It's not one that I necessarily trade a lot of. I would prefer to trade the dollar versus Swiss and the euro as separate instruments. But what I can say here is that in January we do have a double top here at the 127.27 level. We also have this spike low. Whenever the market has a V formation here, always put a horizontal line against that line, folks, because that's a key remembered line. You'll see that the market uses that level as a resistance level. So we are approaching this resistance area here in the euro versus Swiss. We have a double top here. We have a top here. We have a low here. We have a low here. And you can see that it hasn't really traded a lot of volume in this area. So if you're long, good. If you went long, let's say against the hourly chart, this is an hourly chart when the market broke above the 100-bar moving average. Then you have an opportunity. Then you should probably stay long, but look to exit your position as we broach that key resistance level on the top side. All right, I'm getting a question. Could you go over how you exit or the best way that you trail stops, please? That's another question on there. The exit is the same as an entry, folks. I use three tools. I use the moving average, the 100-bar moving average, the 200-bar moving average. I use trend lines, and I use Fibonacci retracement levels. What I mean by have a reason to trade is that if the Aussie versus U.S. dollar comes up to the 100-hour moving average here, and I'm long because I bought at a lower level for whatever reason, what we're talking about exits now. When the market comes up to this key 100-hour moving average, I want to be in, that's a reason to exit the position. I have a clearly defined area that should provide some resistance. We saw it here. We see it again here. Market came down. Where did we come down? We came down to right down to this old low here where the market formed this V here. Remember that V? I put in that line there. That V, guess what? When the market fell to that level, it came down. Guess where the market went up to when the market corrected? Right to that point right there. This is what the market remembers. This is what I call remembered lines. When the market broke above that level here today, where did we go? We went to the next target, the 100-hour moving average. Where did we come down to? We came down to this V, this area right here where the market bottomed and formed this V. The market's very visual at times. The foreign exchange market is very visual at times, and it almost becomes so visual that and that's what you want. That's what you want. You want to see the market react this way. It takes the risk out of the trade. Getting back to the answer, what you want to do in the as far as taking profit and exiting a trade is use one of the tools like this support line, like this moving average line, like this 50% retracement line. And if you know that, okay, what's going on in this currency pair, the market comes up here, comes down here, it catches its breath, moves back above this 50% retracement, moves above the 100-hour moving average. So the bias is bullish here. We should now start to look for that the market has to stay above this 100-hour moving average in order to keep the bullish bias. But right now, the bias is to the upside for the Aussie versus US dollar. So I put a Fibonacci from the high to the low, and I'm going to be starting to target this 38.2% retracement line. I'm going to let me take this out to make it clearer to you. But 38.2% retracement line comes in at the high right here. That's possible. 99.73 is possible. That's our target as long as we stay above the 100-hour moving average. I hope that answered your question for that for exiting. Euro yen at 109. Okay, let's take a look at the euro yen here. We have a few more minutes, and I'll try to get through as many as possible here before we call it a day, call this seminar. Where is the euro yen? Euro yen. You're looking at the 109 level. All right, let's take a look at the daily chart here first. Anymore. I have this old trend line here coming in here. We broke through that trend line, moved above it. You can see how the market, even when it breaks, I like to keep the trend lines in. You can see how it doesn't really trade a lot of volume there. We're at this key underside of the trend line right now at the 108.80 level, and testing that level as we speak on the sorry, Greg, we're going to finish in 1 minute. Okay, I got to finish up, but the euro yen broke above. What we see here in the euro yen is that the market held the 100 bar moving average here today, gave you a couple buying opportunities here. This opportunity where the market tested the 200, came back down to the 100, broke through the 200, broke through this trend line here on the hourly chart, moving up to resistance right here, 61.8% retracement is at 108.92. That's close to 109. Thank you very much for coming in. Thank you, FX Street, for providing me with this opportunity once again. I wish you all good fortune in your trading. If you want to have my 10 reasons sent to you via email, you can send me an email at greg@fxdd.com. I also do things like webinars and other commentary that I send out on a daily basis. Again, you can see my stuff on FX Street as well. So there's a lot of resources that you can use that that I participate in. But thank you again, people at FX Street, and everyone. Have a good fortune with your trading. Bye-bye now.